Did you know that IBM, a company over 100 years old, has reinvented itself more times than any other tech giant? Despite its age, IBM still generates over $60 billion in annual revenue, with nearly 50% coming from cutting-edge cloud and AI services. But here's the kicker. While many see IBM as a slow-moving dinosaur, it quietly holds more patents than any other US company, with over 1,400 AI-related patents granted in a single year. Surprised? That's just the beginning. Understanding IBM's financials is like cracking a code. Beneath the surface, there are hidden signals that reveal the company's true value and potential risks. In this video, we're diving deep into the world of financial statements, but not in the usual boring way. We'll uncover secrets buried in the balance sheet, dissect the income statement's mysteries, and follow the cash flow to see where the money really goes. We'll also break down key ratios and adjust earnings per share to strip away any illusions. By the end of this video, you'll see IBM not just as a tech icon, but as a living, breathing financial entity. So, if you're ready to learn how to analyze a company like a pro, and maybe even find your next big investment, stick around. The real insights are just getting started. Chapter 1. The Secret Sauce: Unearthing Hidden Gems in IBM's Balance Sheet. When you're analyzing a company like IBM, the balance sheet is often where you find the hidden treasures. Most investors skim through it, but there's a lot more beneath the surface. Let's dive into a few areas where you can discover valuable insights. First up, let's talk about goodwill. Goodwill is often dismissed as just an accounting entry, but it's more than that. It represents the premium IBM has paid for acquisitions over the years. This tells you how much value IBM sees in the companies it buys. But beware, high goodwill can also mean IBM overpaid for a company that might not deliver in the future. Another key area is intangible assets. For IBM, these include patents, trademarks, and software. These assets are crucial in the tech industry because they provide a competitive edge. For instance, IBM has thousands of patents, which generate revenue through licensing. Analyzing the growth or decline in these intangibles can give you a sense of how IBM is innovating or not. Now, let's move on to deferred revenue. This is money IBM has been paid up front but hasn't yet delivered the product or service for. It's a liability, but it also indicates future income. A growing deferred revenue line suggests that IBM has a strong pipeline of future business. One often overlooked area is retained earnings. Retained earnings show how much profit IBM has reinvested back into the business. A steady increase here suggests IBM is not only making money but also putting it back into operations to grow further. However, if retained earnings are stagnant or declining, it could signal that IBM is struggling to generate profit. Next, keep an eye on long-term debt. IBM has historically maintained a balanced debt-to-equity ratio, which means they're using debt effectively to grow without over-leveraging. But if you notice a sudden spike in long-term debt, it might be a red flag, signaling financial distress or aggressive expansion that might not pay off. Lastly, don't forget to check the cash and cash equivalents. IBM has consistently maintained a strong cash position, which is a good sign of financial health. This cash reserve allows IBM to weather economic downturns or invest in new opportunities without needing to take on more debt. Chapter 2. Revenue Revealed: Decoding IBM's Income Statement Mysteries. The income statement is where you see the real story of IBM's revenue and profitability. But to get the full picture, you need to dig a bit deeper than the top-line revenue number. Start by looking at revenue segmentation. IBM has multiple revenue streams, including cloud computing, consulting, and hardware. Each segment contributes differently to the company's overall revenue. For instance, IBM's cloud business has been growing rapidly, making up about 35% of its total revenue in recent years. This shift towards cloud services shows how IBM is adapting to changing technology trends. Another critical area is the cost of goods sold, COGS. This number tells you how much it costs IBM to produce the goods or services it sells. If you see that COGS is rising faster than revenue, it could indicate that IBM's profit margins are under pressure. For example, if IBM is spending more on research and development but not seeing a proportional increase in revenue, that's a concern. Now, let's focus on gross profit margin. This metric is a key indicator of how efficiently IBM is producing its goods and services. A high gross profit margin means IBM is good at keeping production costs low while generating high revenue. However, if this margin is shrinking, it could signal trouble ahead. One of the most telling lines on the income statement is operating income. This figure shows how much money IBM makes from its core business activities, excluding any gains or losses from investments. An increasing operating income is a strong indicator that IBM's business model is solid and that it's managing its expenses well. Pay attention to non-operating income as well. This includes any revenue IBM earns from sources outside its core operations, like interest or investments. While this can boost profits, it's not a sustainable source of income. If you see a significant portion of IBM's income coming from these sources, it might be worth investigating further. Lastly, don't overlook net income. This is the bottom line, showing how much profit IBM has left after all expenses are paid. But remember, net income can be affected by one-time events like tax adjustments or asset sales. It's essential to adjust for these to get a true picture of IBM's profitability. Take a moment to subscribe, and we'll get right back into the video. Chapter 3. Cash is King. Follow the money in IBM's cash flow statement. When it comes to understanding IBM's financial health, the cash flow statement is where you get the unvarnished truth. As the saying goes, revenue is vanity, profit is sanity, but cash is king. This is especially true in value investing. The cash flow statement is divided into 3 sections: operating activities, investing activities, and financing activities. Each one tells a different part of IBM's financial story. Start with cash flow from operating activities. This section shows how much cash IBM generates from its core business operations. It's a critical metric because it indicates whether the company can sustain itself without relying on external funding. For IBM, a strong positive cash flow from operations means it's generating enough cash to cover its expenses, pay dividends, and invest in future growth. An interesting thing to note about IBM is that it has consistently generated strong cash flow from operations. In 2022, IBM reported over $12 billion in operating cash flow, a clear sign that its business model is robust and efficient. Next, move on to cash flow from investing activities. This part of the statement tells you how much IBM is spending on investments in its business, such as buying new equipment, acquiring other companies, or investing in research and development. For example, IBM's acquisition of Red Hat in 2019 was a massive investment aimed at boosting its cloud business. While this shows IBM is committed to growth, it's also important to watch for excessive spending, which could strain its cash reserves. Then there's cash flow from financing activities. This section reveals how IBM manages its capital structure, including issuing or repurchasing stock, borrowing money, or paying dividends. IBM has a long history of returning value to shareholders through dividends. In fact, IBM has paid consecutive dividends since 1916, which is rare in the tech industry. One key point to watch is how IBM balances its debt repayments with dividends. IBM's debt levels have been relatively high, particularly after the Red Hat acquisition, so it's important to see how the company manages this in its cash flow. Also, pay attention to free cash flow, FCF. FCF is essentially the cash IBM has left after it covers all its capital expenditures. This is the cash that IBM can use to pay down debt, buy back shares, or invest in new projects. It's a critical metric because it shows whether IBM can grow its business while also rewarding shareholders. In recent years, IBM's free cash flow has been around $7 billion annually. This level of FCF suggests IBM has a solid cushion to handle economic downturns or unexpected expenses, which is reassuring for long-term investors. Lastly, look at the net change in cash. This is the bottom line of the cash flow statement, showing whether IBM's cash reserves are growing or shrinking. While a decrease in cash might not always be bad, if, for example, it's due to strategic investments, a consistent decline could indicate trouble. In summary, IBM's cash flow statement provides a clear picture of how the company is managing its money. By focusing on operating cash flow, investing activities, financing activities, and free cash flow, you can gauge IBM's financial stability and its ability to generate value for investors over time. Chapter 4. Margin Magic. IBM's profitability ratios. Decoded profitability ratios are like a magnifying glass for IBM's financials. They help you see how well IBM is converting revenue into actual profit. Understanding these ratios can give you insight into IBM's efficiency and its potential for long-term success. The first ratio to look at is the gross profit margin. This ratio shows the percentage of revenue that exceeds the cost of goods sold, COGS. It's a direct measure of how well IBM controls its production costs. IBM's gross profit margin has hovered around 50% in recent years, which is solid for a tech company. A stable or increasing margin indicates that IBM is maintaining efficiency even as it shifts focus towards high-margin services like cloud computing. Next, consider the operating profit margin. This ratio goes a step further, factoring in operating expenses like research and development, selling, and administrative costs. For IBM, an operating margin around 15–20% has been typical, reflecting its ability to manage costs while still investing in future growth. This margin is a key indicator of IBM's core profitability, as it shows how much profit the company makes from its operations before taxes and interest. Now, let's talk about the net profit margin. This is the bottom line, literally. The net profit margin shows the percentage of revenue that IBM keeps as profit after all expenses, including taxes and interest, are deducted. A net profit margin of around 10% is common for IBM. While this may seem modest, it's important to remember that IBM operates in a highly competitive industry where margins can be squeezed. A stable net profit margin suggests IBM is effectively managing its costs and delivering consistent returns to shareholders. Another crucial ratio is the return on equity, ROE. ROE measures how effectively IBM is using shareholders' equity to generate profit. A higher ROE indicates that IBM is making good use of its equity base to produce earnings. IBM's ROE has typically been around 35%, which is strong and indicates that the company is generating substantial returns on shareholder investments. Let's not forget return on assets, ROA. ROA shows how efficiently IBM is using its assets to generate profit. With an ROA of around 7–8%, IBM demonstrates that it's effectively leveraging its assets, though it's worth noting that asset-heavy companies often have lower ROAs compared to service-oriented businesses. Finally, consider the operating leverage. This isn't a traditional ratio, but it's a useful concept. Operating leverage measures how a company's operating income changes with sales. IBM, with its mix of high fixed costs and recurring revenue streams, typically benefits from high operating leverage. This means that even a small increase in revenue can lead to a larger increase in operating income, boosting profitability. Understanding these profitability ratios helps you see beyond the surface numbers. They reveal IBM's efficiency, its ability to manage costs, and its potential for generating profits in the future. For value investors, these insights are crucial when deciding whether IBM is a good long-term investment. Chapter 5. Leverage and liquidity. Spotting red flags in IBM's financial leverage. When it comes to evaluating IBM's financial stability, understanding leverage and liquidity is key. These two concepts can reveal potential risks that might not be obvious at first glance. As Warren Buffett famously said, "Only when the tide goes out do you discover who's been swimming naked." Let's dive into the numbers to make sure IBM isn't caught off guard. Start with leverage ratios. Leverage shows how much IBM relies on debt to finance its operations. The most common ratio here is the debt-to-equity ratio. This ratio compares IBM's total debt to its shareholders' equity. A higher ratio indicates that IBM is using more debt relative to its equity, which can be risky. IBM's debt-to-equity ratio has been around 2:1 in recent years, which suggests a moderate level of risk. However, after the Red Hat acquisition, this ratio spiked, raising some eyebrows among investors. Another important metric is the interest coverage ratio. This ratio measures IBM's ability to pay its interest expenses on outstanding debt. You calculate it by dividing IBM's operating income by its interest expenses. A ratio above 2.0 is generally considered safe. IBM's interest coverage ratio has typically been around 6:1, indicating it's comfortably managing its debt payments. But keep an eye on any significant declines in this ratio, as it could signal financial strain. Now, let's look at liquidity ratios, which tell us how well IBM can meet its short-term obligations. The current ratio is a good starting point. It compares IBM's current assets, like cash and inventory, to its current liabilities, like short-term debt and accounts payable. A current ratio above 1.0 means IBM has more current assets than liabilities, which is a good sign. IBM's current ratio has hovered around 1.3 in recent years, indicating a healthy liquidity position. Don't forget to subscribe so you never miss an update from us.